My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to a special Seattle edition of Mad Money, coming at you from the iconic Space Needle in the heart of the Emerald City. Other people make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. So I come back from Italy, all optimistic. Yet all I can hear is that, prego, I truly don't get it. That I fundamentally misunderstand the problems facing this overvalued market. Never mind that we got another nice day today, with Dow gaining 230 points, S&P climbing 1.06%, NASDAQ jumping 1.27%. Sometimes I just want to tell these doubters, as I did constantly to strangers on my trip, don't give up the ship. There are some good things happening, including things right here on location in Seattle, where we'll be talking to the CEOs of Amazon Web Services and Expedia. But anyone who's optimistic in this environment is, of course, on the defensive. Why? First, the bears say inflation's running rampant. No matter what the Consumer Price Index says tomorrow morning, no matter how much better it is than the consensus, it just doesn't matter. Their attitude is the Fed's going to keep raising and raising and raising and raising, maybe taking them up to 4 to 5%. What market can survive that kind of pressure? Surely not this one. Second, I keep hearing that earnings will fall well short of expectations. Just look at the lead story in the Wall Street Journal this morning. You don't want to own a single stock if there's a high chance that you're walking into an earnings shortfall. Third, these days, the government seems like an endless source of pain for Wall Street, unless you make solar panels. Great moment if you care about the environment, but pretty darn suboptimal if you care about the stock market. Fourth, here come the layoffs. The news today that Goldman Sachs is preparing to lay off several hundred bankers shows that a recession has to be on the horizon. You sure don't lay off bankers if things are getting better, right? Finally, of course, there's the chronic overvalued machine that is tech. I am sick of this. The semiconductor stocks are teetering. Yeah, okay. Pushed over by China's ridiculous COVID strategy, if you can call it that. Plus, its belligerence on our government's intransigence in response, this time potentially blocking some of the big semiconductor capital equipment makers from selling to the Chinese, along with the chip makers who have the most sophisticated tech for artificial intelligence. All right. Put it all together. And it's easy to argue that this current rally might be chimerical. Nothing more than a temporary oversold bounce, one that speaks more of fantasy than fact. So let me rebut each of these bears' points head on. First, inflation comes in many shapes and sizes and flavors. We know commodity inflation peaked months ago, especially the highly visible fuel complex. It hasn't mattered one bit, though, because we still have the intractable food complex and the wage inflation. The Fed can't do anything about food prices. We got water shortages, bad weather, and just a huge chunk of the world's crop supply vanishing thanks to the war in Ukraine. Fed Chairman Powell does not control it. Still, we know that there are ways around these rising prices. You don't have to just take a beating. Tomorrow, for example, we're seeing Craig Jelinek, CEO of Costco, which we own for the Travel Trust. Costco is doing an incredible job holding the line on food costs. It's a gigantic retailer. There's an aggregate food number that comes in every one of these indices, but it's going to not be good, all right? But creative consumers can avoid the real bruising prices by becoming a member of Costco. It's not so hard. There's like 100 million of them. If the Fed only looked at Costco, we'd stop worrying. How about wage inflation? All right, this is the stickler. That's something the Fed can and must deal with, although they have to thread the needle between excessive layoffs and excessive wage increases. Now, that's why I think Jay Powell should hit us with another 75 basis point rate hike next week, then maybe follow up with a 50 basis point hike at its meeting in early November if wages don't stabilize. That is nirvana, people. But it's not like we're making no progress on the wage inflation front at all. We know that the biggest driver here is what I call the job hop. We've had a severe labor shortage in this country, courtesy of COVID, so I think it's nuts that the bears want to harp on both inflation and layoffs, because layoffs will put an end to job hopping and tame wage inflation. So many jobs are being lost at busted IPOs, SPACs, the terrible VC world, and positions that are simply not being filled at many big places like Meta Platforms. I can't think of many major companies that are even hiring. How about these potential earnings shortfalls. I have no doubt that there will be some disappointments. But, man, we were supposed to get hit with a wave of forecasts by now from all these big conferences we're hearing. And so far, we've only had a few. More on that later. Okay, I will give it to you. Some groups are struggling. The semis are indeed awful. And not just because the government's banning sales of AI chips to China, and that's effectively punishing AMD and NVIDIA for what? For being too smart? But the semi-complex is down 40% peak to trough. Dude, that's the worst decline of that group in a decade? Even when you put aside the geopolitical rivalry, the Chinese government keeps wrecking its economy with its endless quest to stop the spread of COVID. The whole point of the lockdowns in the rest of the world was to get things under control until we got vaccines. But China won't use the good stuff because they prefer their less effective homegrown alternatives that don't really work. Until the Communist Party changes its vaccine policy, zero COVID means intermittent lockdowns forever across the whole country. This is the worst failure of communist science since Lysenko. Unfortunately, for the first time since the 60s, China's back on the same page with Russia as President Xi and President Putin get together later this week to talk strategy and mutual friendship. That said, I don't see China offering much material support for Russia's invasion for Ukraine. They're basically taking it as an opportunity to buy Russia oil and gas at a huge discount. Which brings me to the single most important fact that the bears just refuse to accept. Ukraine's winning the war, and they're going to drive out Russia, something that would resuscitate Europe's choked-off economy, which is currently being kept afloat by our own oil and gas exports. There were always two political analogs for the Russian invasion. Boris Yeltsin's failed farcical invasion of Chechnya in 1994 and Putin's spectacularly brutal annihilation of Chechnya years later. Most people assumed the war in Ukraine would follow the second pattern, Putin crushing another outmatched opponent, just like he did with Chechnya. But Ukraine's much larger than Chechnya, with 30 times as many people, and their government received extensive military assistance from the West. Plus, unlike Chechnya, in the Second War, there were hardly any turncoats, in part because Ukrainians remember the brutal repression that they suffered under Russia early in the 20th century, especially during the 30s, during the Great Famine that was caused by Russia. Ukraine's now made a huge breakthrough in the East, and they're running circles around the Russian army, which has been hollowed out by decades of kleptocratic rule. A Ukrainian victory seemed like a wild card just 6 months ago, but now it's looking like an ace of spades. Obviously, this whole war has been a horrifying humanitarian disaster. But if Ukraine can win, which means pushing Russia out of Ukraine, not Crimea, but Russia, but just Ukraine, that will be huge for the stock market. As long as Russia doesn't go nuclear to save face, we will get a return to business as usual, which would lead to a collapse in oil and gas prices and some terrific earnings for our tech companies that do so much work in Europe. Food prices would come down, too. The euro itself would make a comeback, very bullish for our country, allowing our international companies to make much more money overseas. Here's the bottom line. I have many more reasons to believe the lows have already been put in, including, by the way, Apple's spectacular $6 run today and an unprompted rally by Amazon right here. But let's not overlook the elephant in the room. If things are really so darn bad, if the negatives are so self-evident, then why the heck do stocks keep pushing higher? I want to take some calls. I want to go to Ronald in New Jersey. Ronald!
Booyah from New Jersey's number one city, Newark. A few weeks back, Zoom had a bad earnings print, and you made a great point that they may need to recreate themselves post the pandemic. Do you think they're a possible acquisition target? And if so, by who?
I don't think they can be a possible acquisition target. I'll tell you why. Because this Teams, every time you put if you don't have like an Apple device, let's say you have an HP device, you put it on, it says Teams. It comes right out, Teams. It's like, a bad fantasy team. So, no, I think there's really nothing right now that Zoom can do. I'm sorry. Nice people. If things are really so bad, if the negatives are so self-evident, then why the heck do stocks keep pushing higher? On Man Tonight, we're taking investing to new heights from the Space Needle in Seattle. Everyone knows Amazon, but could its cloud computing business be the key driver for the company as the world digitizes? I'm talking to the top brass of Amazon Web Services. And two consumer packaged goods players slashed their guidance recently. I'm revealing the names and what the cuts are saying about the state of the market. Plus, I'm going one-on-one with the CEO of Expedia. Oh, what a stock! To get a read on demand for travel. So stay with Cramer from the Space Needle in Seattle.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.